Hello class, this is a review of how to post journal entries for the issuance of stock. And I know that we haven't talked about it before. I'm sure you've read it in your textbook, but I thought I would just discuss it with you and review it at the same time through working problems. So when you issue stock, there's three types of stock that we might issue. There's par stock, stated value stock, and no par stock. And so par stock, par value has a stated value on the share of stock. Like here when we're looking at this common stock, it has a par value of $20. Now the thing about par value is that it doesn't really have any significant meaning anymore. It used to be the amount that the company had to set aside to pay the shareholders in case of default, but now you'll find that the par value of stock is often pennies or portions of pennies. So it doesn't have any significance from that respect, but it has a lot of significance in how we record the journal entry. Because what we're going to do is we're going to use the market value to figure out how much cash we get paid. And then we're going to use the par value is what goes into the common stock account. The par value is what goes into the common stock account. And everything else is going to go into a new account called paid in capital. And you're going to see different paid in capital accounts over the next year. This is paid in capital in excess of par. And you'd probably see it written paid in capital in excess of par, common stock, because it could also be preferred stock. It could be treasury stock. So I'm simply going to say paid in capital, right? So that I don't have to write the whole thing out because I'd need a larger screen. But that's how this works. There's a lot of different paid in capital accounts. And then where you're going to see these paid in capital accounts on the financial statements is they're all part of equity. So if you looked on a real balance sheet, you would see under equity retained earnings, and you would see less dividends, and you would see common stock and preferred stock if they happen to have it. And then you'd also see paid in capital accounts adding. And you might see treasury stock subtracting from equity. So this is paid in capital is part of equity. So for this first entry, a corporation issued 4,000 shares of $20 par value common stock for $96,000. All right, so the first thing we know is we received cash, right? I'm turning my calculator on. The first thing we know is that we received cash. So we received cash of how much? We received cash of $96,000. Cash is an asset. When we increase it, we debit it. For our common stock account, we're going to take the 4,000 shares times the par value so we have 80,000. So the common stock, we're going to record at 80,000. That's what we put into the common stock account, the par value. The difference goes into our paid in capital common stock account. So the difference is 16,000. And this is always going to be the market price minus the par value. Now, we weren't given the market price. We could figure it out if we took 96,000 divided by 4,000. But in this case, we weren't right out given it. But we do know that everything else goes into the paid in capital account. So for the first journal entry, we're going to record cash 96,000, common stock 80,000. So I'll go down there and I'll do that. So cash, oopsie. There it was. Paid in capital in excess of par, common stock, 16,000. All right, are we good here? Let's look at the second one. Now we're going to record the issue of 2,000 shares of no par common stock to its promoters in exchange for their efforts, estimated to be worth 58,000. The stock has a $3 per share stated value. Okay, there's a couple of interesting issues with this. So the first one is that, as you can see, this is no par stock. So since I would normally put the par value into the common stock account, and this doesn't have a par value, I have to put everything into the common stock account, because the other option would be to put nothing into the common stock account and everything into the paid in capital account, and that of course would make no sense at all. So I am going to put everything into the common stock account because there is no par value. So the next thing to look at is we didn't receive cash for this common stock. Instead, they gave work in exchange for common stock. So I have to look at how much value did the work have. If I had paid for the work, I would have paid $58,000. So I didn't pay for the work, but I'm giving them stock in exchange. So therefore that stock must be worth $58,000. Oh, I'm wrong. It's no par, but it has a stated value. So the stated value behaves just like par. Stated value is just like par value. And it goes into the common stock account. So if I have 2,000 shares at $3 stated value, I'm going to put $6,000 into the common stock account. If I received 58,000 and 6,000 goes into the common stock account, then 52,000 must go into my paid in capital account, because all the rest, the difference, has to go into paid in capital. Let's try that. So I'm not going to receive cash. Instead, I have, what do they want to say? Not labor, promoters, advertising. See what revenue, what expenses we have. Well, the only expense we, promoters in exchange for their efforts. Okay, so the only expense we even have is organization expense. So they did $58,000 worth of organization for setting up the company. And I'm going to issue common stock with a $3 stated value for 2,000 times 3, so $6,000. And I am going to put all the rest into paid in capital in excess of par. It's still, oh, in excess of stated value, common stock. So pay attention to those issues. So this is 52,000. Also, since I see that, I'm going to go back to number 1, and I think this, oops, that was wrong anyway. Common stock, this had $20 par value, $20 par value. All right, now number 3. Now it's the same transaction, but the stock has no stated value. Since the stock has no stated value, it's the same as having no par value. I'm going to put all of the money into common stock because I can't just skip the common stock account. So my debit is still going to be organization expenses. for $58,000. But now I won't have any paid in capital account because everything is going to go into my common stock account, because I can't just skip the common stock account. So if it has no par or no stated value, everything goes into the common stock account. All right, and the last one is we're issuing preferred stock. The good thing to know is that if you know how to issue common stock, then you know how to issue preferred stock, because it's all exactly the same. You just say preferred stock instead of common stock. So we have 1,000 shares of $75 par value, and we received $133,000 cash. So I'm going to take my 1,000 shares times $75 par value. So I have $75,000 worth that is going to go into preferred stock. Everything else, this is the total we received. This is the amount of the par value. Huh, that's ironic. 58,000 is going to go into paid in capital in excess of par preferred stock. So let's look at how that entry works. We're going to record cash of 133,000. We're going to record preferred stock, and this is $75 stated value, par value, $75 par value for 75,000, and then paid in capital in excess of par preferred stock or 58,000. Okay, so that's it. That's how to record the journal entries for stock. So let me get rid of my writing. So there we go. We did 4 of them. All right, next up, I'm going to do the practice problems from the last 2 chapters.